just to describe what's moving around my head right now, as I said, it is a very complex world. You could mention this new environment with negative interest rates. You can talk about, as Marcus Wallenberg mentioned before, stagflation, low inflation. We also have lots of other problems. We have a discussion about the oil price, the currency war, the ongoing currency war, the discussion about Brexit. We have a situation with record high debts in the global economy. We have the Russian crisis, signs of slowdown in the Chinese economy. We have populism growing in Europe. And if you look at this slide, then I think we have to maybe spend the last week or so to discuss all these kind of things. And of course, we don't have that time. But I will mention and I will comment on some of these. But just to summarize all these kind of challenges that you see in front of you, maybe in the future we have to learn a kind of new word. I think you could summarize it in a kind of new definition, and that is geoeconomics. And that we have this kind of you could say, increasing interplay today between the geopolitical situation and the economic situation in the world economy. But taking a look at the world economy and give you this kind of a very big picture of what's happening right now in the world economy, I think you have reasons to be cautiously optimistic about the future. I can see 4 very important growth drivers for the global economy. The first driver, that is of course monetary expansion. If you look at what central banks are doing, they are cutting interest rates. We have negative interest rates in several countries. We can see central banks printing money. I think that will provide support to the world economy. Rising asset prices, if you look at bond prices, equity prices, house prices, this is very important for households. You get this kind of wealth effect. And normally that will also give you slightly stronger private consumption. Then we have lower energy prices. If you put the new oil price into your economic models, that will give you much higher economic growth. And finally, for many countries, we can also see weaker currencies. Maybe not for the US dollar, but for many countries, you can also see weaker currencies, and that should provide support to the export sector. So these 4 factors are quite important when you look into the future, and I think they will provide fairly good support to economic growth. But we also still have very big challenges. We have the geopolitical situation. We have the changing of balances between countries in the global community. We have the geopolitical situation, the Russian-Ukraine crisis. We have also some question marks about the Euro project, because right now we don't see further integration. We see signs of disintegration, and that could jeopardize the stability of the euro going forward. And finally, the pros and cons with QE, central banks printing money. And at some point in the future, we have to implement exit strategies. What kind of implications will that have on the financial system and also on the world economy? So, positive drivers for economic growth, but still very big challenges. Looking at central banks today, it is a kind of unique situation. We have never seen it before, this kind of huge expansion of monetary policies. On the left-hand side, you can see the size of the balance sheet of a couple of central banks. You can see it for the Eurozone or for the European Central Bank, for Japan, for the US, and also the UK. And it shows the size of the balance sheet in relation to the size of the economy. If we have had a kind of normal situation, these lines should have moved sideways. But they are just skyrocketing, which means that the central banks are printing much more money than the economy is asking for. And of course, you can also see that Japan has tried this kind of experiment for the last 20 years. And they still have some problems with economic growth and with inflation. If you should try to summarize how much money central banks have created the last 7-10 years, then you will end up with this number. 15 trillion US dollar. That is the excess liquidity that you have in the world economy right now. And just to give you some kind of reference point, 15 trillion US dollar, that is roughly 20% of the global stock market cap. So we shouldn't be surprised now when stock markets are rising, because they get lots of support from this kind of liquidity injection. As I said in the beginning, it is a kind of unique situation for central banks. We have never seen it before. We should also know that central banks, they have no limits. They can continue forever creating new money. And what's happening right now when central banks are buying huge amount of assets, it's quite good because it means that you will get a kind of risk concentration. Because if you believe that maybe the assets that you are holding, maybe they will suffer a couple of losses, then it's good that you will find these kind of assets on the balance sheet of a central bank. Because if the central banks are facing losses, and that will maybe give you a negative equity, central banks, they can run their business with a negative equity. That is without problems. But one problem, that is actually what the central banks are doing right now. That is not, provide solutions to problems with high debt levels or high unemployment rates. We are buying time. But at some point, we also need political decisions. And right now, you could say that we see some signs of that the politicians are actually slowing down when it comes to political decision-making. I think that maybe central banks today are doing too much. You have the European Central Bank. They are buying every month 60 billion euro. And I think we are creating kind of mispricing of risks in the financial system right now. I think that the central banks are aware of this. And this is also what they would like to see, because they are buying different kind of assets to improve the credit supply. They would like to see stronger balance sheets, rising asset prices. They also would like to increase the liquidity in the system. But I think we have a kind of compressed situation with compressed volatility in the financial system. And at some point, when the central banks are slowing down their activities, or maybe reversing their activities, I think if you get volatility, we have a new situation with less risk-absorbing capacity. Because due to new regulations, capital requirements for the financial system, for the banks, you don't have the same kind of risk-absorbing capacity. And that could end up with even larger volatility in financial markets. And I think that at some point in the future, we have to pay the bill for what's happening right now with central banks. And when I say pay the bill, it means that maybe we will get too many investments right now that are not that very good. It means that we will get credit losses, slowdown in economic growth, but we could also end up with financial imbalances. Because what's happening right now, that is a kind of, we have a growth in the financial economy, very much supported by central banks. But we are still waiting for strong growth in the real economy. We have this kind of increasing gap between the financial economy and the real economy. This is a kind of dangerous scenario going forward. So we are still waiting for stronger growth momentum in the real economy. One factor, as I mentioned before, which is very important for your global outlook, that is oil prices. On the right-hand side, you can see the table. We believe that the oil price, on average for this year, will be around $60 per barrel. This is for Brent. And next year, we believe that the oil price will be around $70 per barrel. I think it's quite difficult to make this kind of forecast. But I think that the long-term trend for energy prices, that is downwards. In the short term, I think the reasons for the decline in energy prices and the oil price, that is increasing supply. I think that you could explain roughly 70% of the price decline by increasing supply of energy. Shale gas, shale oil in the US. We have Saudi Arabia, which is also providing much more liquidity, more oil into the global economy. Roughly 30% of the price decline is due to lower demand. I would say more efficient consumption of energy, but also due to the slowdown that we have seen in emerging markets. And looking at the impact, of course, it will have a positive impact on, world economic growth. It will also have an impact on the price levels, but this is not good because we have very low inflation in the world economy. There is a risk of deflation. But when we talk about deflation, looking at the impact from oil prices, we are talking about good deflation. Price pressure coming from the supply side, that is good for the economy. But if we see an impact on inflation expectations, or even if we end up with deflation expectations, then we have a problem. But as long as we have only this kind of supply effect on inflation, then it's good for the world economy. But there is one, could say, risk factor. That is that when you have this decline in energy prices, it means that some countries are very dependent on energy prices, energy revenues, and then they could end up with some geopolitical uncertainties or problems. And one of these countries are Russia. On the right-hand side of the table, you can see our forecast, GDP forecast for you have Russia and Ukraine. We believe that the Russian economy will decline by 5% this year, and by another 1% for 2016. And it's quite obvious, I would say, that is that the oil price and the decline in the oil price has revealed the underlying weakness in the Russian economy. Because during a very long time, we have seen very low levels of investments, including the energy sector, but we have also aging population, which means that your production capacity is declining. You cannot create economic growth. We have seen the ruble collapse. Well, we know that the Russian central bank, they have capacity to affect the currency. But in the short term, we also expect to see much higher inflation. During the first half of this year, we expect inflation to rise by around 20% or reach the 20% level during the first half of this year. The average, you can see, we expect the CPI inflation will be around 16% for 2015. This means that you will have negative implications on the household sector. You will reduce the purchasing power. But there have been also some concerns about Russian banks, Russian corporates' access to foreign currencies due to all these kind of sanctions that you have seen affecting Russia. But just before Christmas, one very interesting thing happened, and that was that China decided to reach an agreement, a swap agreement with Russia. You got a swap agreement between the Russian central bank and the Chinese central bank, which means that the Russian central bank have access to the Chinese FX reserves. And if you look at the size of the Chinese FX reserves, we are talking 4,000 billion US dollar. So that means that Russia they have actually access to foreign money or foreign currencies if that becomes necessary for them. And then we have, of course, Ukraine. You can see the forecast once again in the table. A substantial drop in economic growth, but now we get this kind of bailout measures. But it's going to be a very challenging environment for Ukraine going forward. Geopolitics and economics, which I would like to call geoeconomics. We have this kind of very complex interplay that is now changing, I would say, the global balance of power. We have very rapid changes taking place right now, and that will change the roles of different countries. We will get new game roles between countries, and that is actually adding some uncertainty to the global economy. The key driver for very dramatic changes in the economic environment, that is, of course, globalization. Globalization will continue, and it will change the balance of power between countries. You can just look at Asia right now, accounting for 45% of the global economy. We have also high levels of indebtedness in many countries. It means that you don't have any flexibility at all to change your economic policies that can support economic growth. States, central banks, Very powerful, especially if you look at China. We have very big, very substantial demographic changes, aging populations in many countries, immigration issues, etc. All these kind of factors are changing the economic landscape right now. And at the same time, looking at the geopolitical situation, you have, it's moving very slowly, increasing nationalism. You have rising inequalities between households that could create political, social tensions. You have a movement towards more democracy, which is very important, but that is also adding some uncertainty to the geopolitical environment. And finally, the access to different kinds of resources, natural resources. You can think about shale gas, shale oil, that is now changing the energy landscape, and that will also hopefully give support to economic growth, but in the short term, you are changing this kind of geopolitical landscape. And this is a kind of new dimension, geoeconomics, that makes the situation a bit more complex. Looking at the Eurozone right now, on the left-hand side, you can see our forecast for economic growth, and you can see Germany, fairly good economic growth for 2016. Close to 2% of GDP growth should be close to around 2%. What's happening right now, that is, we see the positive impact from the weakening of the euro. On the right-hand side, you can see the export developments for Germany, Italy, France, and this is exports outside the euro area. And you can also see the gray line, that is the value of the euro. And it is quite obvious that the weakness of the euro has started to have a positive impact on exports. And together with the euro, the ECB is also providing support, and you could also add declining energy prices. That should support this cautious Eurozone recovery for the next 2 years. At the same time, we should not forget that we have huge imbalances between countries within the euro area, very high levels of indebtedness still in the southern part of Europe. We see less economic policy integration. I think we are moving in the wrong direction. We need to have much more integration, cooperation between the 19 Eurozone countries. And as long as we are moving in the wrong direction, towards less integration, you will jeopardize the stability of the euro. So that is a major concern, I will say. And finally, this kind of political populism. You can look at Greece, Syriza. They are coming from more or less 0%. And they are now the government of Greece. It's a kind of political earthquakes taking place within the euro area. And we have to be aware of that, looking into the challenges for the Eurozone going forward. Inflation. We are still searching for inflation. We have for some time, you can see what you see in front of you is our inflation forecast for the US and also the Eurozone. And you can see a quite substantial drop in inflation for this year. Actually, we believe that we are going to have deflation, CPI deflation, in the US and also in the Eurozone for 2015. We are searching for inflation. And the potential drivers for inflation, well, printing money. But we have seen that taking place in Japan. We have seen that if I look at the correlation between money supply growth and inflation the last 20 years, I cannot see any correlation between money supply and inflation. So I don't think that this will generate inflation. The second factor that could generate inflation, that is higher wages. But if I look at what's happening right now in the global economy, I can see that wage growth are declining in many countries. And that means also that you will have a declining inflationary pressure. Energy prices, as I said before, I think the big trend, that is declining energy prices. Food prices, well, I think you could, well, the forecast is that we should expect more or less prices moving sideways. Taxes. If you raise taxes, then you could get slightly higher inflation. And then you could look at Japan. They raised the VAT on the 1st of April last year. And they got some inflation. But now, once again, inflation is falling. But they also got a recession, a new recession. because you had a very negative impact on private consumption. So I don't think this is not a solution to create inflation. And then many countries today, they are focusing on the currency effect. If they could depreciate their currency, they will get higher imported inflation. But the problem is that all countries around the globe, they cannot get a weak currency at the same time. But if you look at central banks today around the globe, they're actually driving the monetary policy towards levels that will give them a weaker currency. So it's quite obvious that we have a currency war going on right now. I think that inflation is a global phenomenon. Inflation is decided on a global level, and the key driver for inflation, that is how much excess capacity that you have in the world economy. And today, my conclusion is that you have excess capacity in Asia, you have it in the US to some extent, you have it also in Europe. And as long as that is the case, it will continue to exert a downward pressure on inflation. So when central banks today, countries, if they think that they could depreciate their currencies to get some slightly high inflation, that is not a solution to the global disinflationary environment. And there is, of course, a risk that this kind of currency war will end up with more protectionism. And that is not good for economic growth. Looking at our forecast for central banks, you can see 4 different central banks. We remain at very low levels. You can look at the Federal Reserve. We believe that they will start raising interest rates in September. We are a bit uncertain about this forecast. If I look at the most recent economic indicators for the US economy, I can see some early signs of losing momentum in the US economy. But I think that they will start raising interest rates, that they will start raising interest rates in September, despite this kind of low inflation environment. One very critical factor for global growth, that is how Fed will play this kind of game with currency wars. Because I think that the US economy can afford a stronger US dollar. But we will get a problem if interest rates will rise aggressively, and especially bond yields. So I think that if the US dollar will continue to strengthen, I think that the US will accept that. But if you at the same time see rising interest rates, then the Fed will slow down its tightening of the monetary policy. And thinking about the ECB, I think, as I said before, I think that the central banks are doing too much right now, exerting a huge downward pressure on interest rates. So we have to keep in mind that maybe, so far the ECB, they have said that they will continue until September 2016 with these purchases of assets. But maybe they will have to start tapering, slow down these kind of purchases before that. Because I think we are creating these kind of financial imbalances. It's not a good scenario happening right now. On the right-hand side, you can see our forecast. We think that we are going closer, that we are actually coming closer to the parity level for the euro dollar. And you can also see the further weakening of the Japanese yen against the US dollar. Looking at interest rates. Today, German interest rates, Japanese interest rates, they are at the same levels. 5 years ago, when I started to mention about the possibility that we could have Japanese interest rates also in Europe, people laughed at me and they said that you're crazy. That will never happen. And today we are at the same levels, Japanese interest rates and German interest rates. And if you look at the interest rate levels, in many countries we have negative interest rates. That means that investors are buying assets and you will lose money at the end of the maturity. So how does it come that you will actually buy these kind of assets with a loss? You know that you are going to lose money. Well, the first explanation to that is of course that people are very afraid about the future. Or maybe you believe that you will get a stronger currency. You have that case in a couple of countries. So you know that you will get a negative interest rate on your asset. maybe you will gain from an FX perspective. Or maybe you have very strong deflation expectations. So that will give you a kind of nice real return on your investments. Or maybe you believe that central banks will just continue to cut their policy rates. Or maybe you believe in more QE, quantitative easing. That if you buy a government bond today, you expect that somebody else will buy this government bond from you. Or maybe regulations. If you look at our bank, we are more or less forced to buy these kind of assets due to regulations. Looking at the interest rate map today, on the left-hand side you can see different countries, and you can see the different maturities on the top. And all this kind of red shaded area, that is interest rates that are negative today. And the green shaded area, that is that you still have positive interest rates. And I think that if you look at what central banks are doing, and also in this kind of low inflation environment, I think we are moving toward, we are coming closer to this kind of green area. So the red shaded area will probably become bigger, at least in the near term, pushing interest rates further downwards due to what's happening right now, especially in Europe with the European Central Bank. Looking at the Nordic countries, the developments right now, on the right-hand side you can see GDP developments. The starting point, that is the collapse of Lehman, 2008. You can see the substantial drop in economic growth, and you can see the recovery. For Norway and Sweden, it looks quite good. Our economies are roughly 7–8% bigger than they were before the crisis. But then you can also see for Finland, we haven't seen any recovery yet. And for Denmark, maybe a bit stronger, but still we are below the pre-crisis levels. In the table you can see our forecast. We believe that Swedish economic growth will be around just below 3% for the next 2 years. We think that is quite good. Fairly good developments also in Denmark. But for Finland, we expect quite weak economic growth for the next 2 years. And if you think about Finland, lots of strong headwinds right now. We have some structural issues with the telecom industry, paper and pulp industry, and of course also the situation in Russia. But I think that Finland will get some support from a very expansionary monetary policy and also weaker euro. Looking at Sweden, well, improving outlook, but I must say that I am a bit concerned about the Riksbank, the Central Bank of Sweden, because they just continue to cut interest rates. Looking at Denmark, I see improving momentum in the Danish economy, and I think that they have been able to survive this kind of currency crisis, reverse currency crisis that we have seen in Denmark. But I think that it looks quite good in Denmark. And then Norway, of course, focus very much on the oil price. And the declining oil price, that means that you have a challenge for the Norwegian economy. And we see some negative impact on consumer confidence and business confidence that will have a negative impact on the overall economy. Looking at the Baltics, improving outlook. Of course, due to the fact that we see improving export environment especially for Europe. You can see on the right-hand side the development for the 3 countries. And you can see also our forecast. We believe that GDP growth for each country should be higher than for the Nordic countries, but we are going to have slower growth compared to the pre-crisis levels. And just a couple of reflections about each country. As I said, slowly improving outlook. We have to rely on private consumption. That is kind of common theme, not only for the Baltic countries, but also for the Nordic countries. Export ratio, of course, that means that the improving export or improving outlook for Europe is very important for Estonia. One major concern, and that is of course the shrinking labor supply that we have to keep an eye on, because that could end up with wage-driven inflation. Very strong real wage increases in Latvia. We have the same kind of potential problems. We are close to near this kind of equilibrium level for the labor market. So that means that we're having some inflation risks. Still weak capital spending and maybe some political uncertainties coming up for Latvia. And finally, for Lithuania, we have seen what we think is resilient economic growth. Once again, strong private consumption, which is very good. The unemployment rate remains at very high levels. Probably we need to see more structural reforms to get more flexibility. The adoption of the euro, quite small impact so far, but we are hoping for stronger effects going forward, especially now when we see the improvements within the euro area. So my final slide, just to summarize how I look upon the current situation, you could just look at, on the left-hand side, the average for the global economy. We believe that we are going to have a slight acceleration in GDP growth from 3.4% up to 3.9%. Of course, driven by QE, lower energy prices. We have also rising asset prices, and hopefully that the US will refrain from joining this kind of currency war. That should be supportive for global growth. We are in this kind of uncharted territories with QE, etc., negative interest rates. Also, when we look at the euro project, geopolitical situation. Everything is changing very rapidly right now, and that is adding some uncertainty. And coming back to central banks, it's quite good that they are trying to provide support to the global economy, but we have to be aware of that maybe we are also creating some new imbalances, challenges for the economy. I think that we have, looking into the future, I think we have great opportunities for the future, but we have to be aware of also that we have great challenges.